Hello and welcome back to Never Change. Here I intend to go through a quick analysis of Coinbase. Please take everything with a pinch of salt. There's a huge margin for error here, but I thought I could try and trend things out and project to see if this is worth what it's being listed for. So what is it? So Coinbase is a cryptocurrency exchange platform that operates remotely. The company was founded in 2012 by Brian Armstrong and Fred, and as of March 2021 it's now the largest cryptocurrency exchange in the United States as per volume. So founded June 2012, employs about 1,700 people, has an annual revenue projected to be about 1.8 billion at the moment. Biggest competitor is probably Binance. There may be others. I've not really done that much research into it, and as of this example in this analysis I'm going to compare some of the things to PayPal. Couldn't find a credit rating for them. Common size analysis. Now we do have some figures from them for 2021. So they're projecting about 1.8 billion in revenue. And net income about 780 million. So there's a bit of a margin for error here because they've not been specific. Is it 1.85 billion or 1.81 billion? So I've gone straight down the middle. So with revenue there's a margin of error of about 2.7% and net income about 3.8%. So roughly there. So it's not really going to change the price of fish. And so from that I've tried to use how they're trending from the last 2 years to kind of guess where they're going to be in regards to costs of goods per service, their operating expenses and their pre-tax income. So everything seems to be trending in the right direction. Again, there's a huge margin for error here, and also free cash flow. They went from negative 121 million to positive 2.9 billion in 2020. So I have no idea what they're going to get in regards to keep free cash flow in 2021. But I can only think that they had cash reserves in crypto and rode the boom with that, and that has returned a huge net free cash flow. It would be interesting to see how they've done in 2021. Things to take away here though is if you look at 2019 before the crypto hype again, which mirrored 2017, they were not making a profit. They are negative 30 million a year, and 2020 they've done well, so 322 million pounds profit, net income, and projecting now to be 780 million. But is it worth the share price that they're asking for at the moment? I think there's probably a lot of hype baked into that price. So more deeper analysis. So let's go through the Moat analysis. Could only do the last so 2020 and the projection for 2021 in regards to EPS, because they had a negative EPS for 2019. So that's coming out at 39%, but that's based on $3.35 earnings per share. That's not what I calculated it to be. I calculated it to be a bit more conservative at 2.89, but I'm going off the more optimistic analyst consensus. So if they can maintain that 39%, but again that's based on the crypto boom. Revenue has gone from 533 million 3 years ago to 1.8 billion, so that's averaged 50% over the 3 years, and can't do book value per share because we've only got 1 year results really. So 2020 financials look very rosy. So the return on equity sits at 33%, far greater than the 10% we're looking for, and the return on invested capital sits at 26%, again far greater than 10% that we're looking for, and the debt to earnings only sits at 0.84 years, so well under that 3 years that we're looking for. So this looks great, but just for perspective, let's look at 2019. Oh dear, -6%, -6%, and can't be done because they don't turn a profit. So again, it just goes to show that this company is very reliant on the continued crypto growth. So margin of safety again is a difficult one because we don't have historical data. So on the model, what I've done is I've worked it backwards and then done a couple of comparisons to what PayPal is doing at the moment. Working from the sticker price of $381 a share, and then based on the EPS 12 months trailing, analysis consensus of 3.35, they would have to have an earnings growth of around 28% and a future PE multiplier of 25. So just to put that in perspective, over the last 5 years, PayPal have managed an earnings growth rate of around 24%, but they do have a future PE multiplier of 47 and a trailing of 77. So yeah, they're going to have to grow at the same rate as PayPal going forward in order to justify, I think, that type of sticker price. So let's do the 8-pillar analysis. Let's see if there are any foundations here. So they're passing 8.5. They're passing 5.5 of the 8 pillars, with a share price at 328, market cap of 85 billion. So the PE ratio is massive. According to my calculations, sits at about 109. Way above the 20, less than 20 we're looking for. Again, just shows how overpriced the stock is. Profit margin 8.4%. They do have revenue growth based on last year to this year's forecast. They do have profit growth based on last year to this year's forecast. Outstanding shares reducing or increasing is not applicable because they've only just listed. Assets are greater than liabilities. Liabilities sit at 83.5% of their assets, and they've had huge cash flow. So I'd be very interested to see what their 2021 cash flow is and if that 2.9 billion can be sustained. Price to free cash flow based on that 2.9 billion is currently sits at 28.68, which again is massive. Run the figures through at a 25% margin of safety based on the current share price would sit at $285.75, which would give a market cap of 74.5 billion, which would still give a PE ratio which is well above the 20 we're looking for at 85, and free cash flow price to free cash flow would sit at 21.24, still too high. Again, so let's do it at 50%. So 50% would be $190 a share. Market cap would still sit at 49.7 billion. PE ratio would still be 56.87, and price to free cash flow would be 16.61, which would be a little bit more acceptable. So the pros for continued growth. So the CEO, Brian, knows that Coinbase has to diversify away from its revenue stream of just transaction fees, and it has to do it quickly. 96% of the company's revenue comes from fees at the moment. So at least they've got a plan for growth. They know they have to diversify, so that's a pro in my opinion. The there's still lots of hype around crypto, and lots of companies are adopting it as a payment method, or allowing you to invest in. Limiting factors is the one that's going to hurt Coinbase the most is the race to the bottom. So at the moment it can charge quite high fees to change whatever currency into crypto. As more exchanges come online, they're going to the only thing that they compete with each other is on price. So there is going to be a race to the bottom, just like what we've seen on the stock market in regards to like FreeTrade, Trade 212, Webull, all offering free trading services. This will be no different. Crypto market is an uncertain beast. There's nothing to say that it could just disappear overnight, and Coinbase is almost 100% linked to this market. 96% of its revenue comes from transaction fees, and it has a plan over the next 5 to 10 years to diversify away from that. That might be too long. 5-10 years is a long time in the crypto space. I'm not sure they have that much time. The current share price is perceived to be very overvalued, just off my rough estimate, based on multiple margin of errors. I come out, my projection of its PE ratio is around 100. Even if I'm 50% out, that's still a PE ratio of 50, so it's very, very overvalued. And also this is going to be a very volatile stock, so this is going to be linked very heavily to the crypto market. Crypto market is inherently a very volatile investment, so this will mirror over more than likely. So my conclusion is, couldn't find a credit rating on it. Concerns regarding the common size analysis, concerns regarding the Moat analysis. Return on equity, return on capital invested looks good, but that's based on just this year. If you look further backwards, I'm sure it won't show such a rosy picture. The long-term debt looks good at the moment, but again, if you just go back 1 year, it doesn't look good at all. And past a few of the 8-pillar analysis. So Coinbase going forward has a huge amount of risk. I would advise you only invest what you're willing to lose in this one. Current share price is very overvalued in my opinion, and everything that I've put through my models shows that it's hugely overvalued. So I based me buying in on a 20% margin of safety, so I bought in at $320 a share, only because I estimated, not in regards to the value of this stock, but just based on the hype. I thought if it dips around to around a 20% margin of safety based off what they IPO'd up, I think there will be a bit of an uptick, and there was, but I'm only looking at about 10 to 15% here, and I'll be straight back out. Now again, so I'm not a financial advisor, this is just my opinion of where Coinbase is. Happy to do you think I've missed something? Am I not calculating something in? Please share, and yeah, thank you for stopping by. Thank you. Bye bye.